Is Ray Dalio right about diversification? In this video, I'm going to break down Ray Dalio's theory, Ray Dalio's process to invest in, and is it right for the individual investor? So remember, this is according to my own research. This is not financial advice. If you do want to keep up to date with markets, I do have a newsletter. Link to that will be in the description. So what Ray Dalio is actually trying to do. So Ray Dalio is something called the all-weather model. So what Ray Dalio talks about and preaches about is having uncorrelated bets, diversification, and what it essentially does is it limits your downside and maximizes your upside. So I've got here the all-weather portfolio is one of his portfolios that he constructs. So 30% stocks, 40% long bonds, and then mid bonds, then gold, and then commodities. So this is one of Ray Dalio's ways of talking about things. But one thing that he also talks about is 15 uncorrelated bets, or 15 I've got there 10 to 15 income streams from different sources. So if one fails, you're fine. So you might have, for example, a massive loss in tech stocks, but because you've got real estate and gold, you're going to do okay. So Dalio's goal is to never lose a lot of money. So in the great financial crisis, he did near 10% when the stock market did down 40. So his whole thing is he's worrying about his losers more than his winners, which is a really good approach to have when it does come to investing and risking your money. So yeah, his whole thing is if one asset doesn't do well, your downside is reduced, and you're gonna almost absorb that downside from your other bets, which are completely different. So it's really interesting to see, and hedge fund managers are always really interested when they talk about their processes, because what Ray Dalio is saying is this is the way to do it, but there's people out there who have completely different approaches and styles to doing things. So in my opinion, these are the main problems. So opportunity cost. So if you were a investor like this way and you were focusing on 15 different assets and you're focusing on, let's just say, crypto as one of them, well, you've not done too great compared to the person who was following momentum when it comes to, let's say, whatever's trending. So at the minute it would be tech. Early in the year it would have been commodities. Now, I don't believe this is the approach that most people should do, if I'm going to be completely honest, but I think it's worth knowing, if you're a person who's investing in something because it keeps dropping down, you've also got, consider opportunity cost. You've also got to think, this might not recover and make, profit on this investment for a couple of years, and inflation adjusted, that's maybe not going to be as profitable as it would look. So they're definitely things to consider. And also you cannot, master 15 assets at once. If you want to be a pro, let's just say financial markets investor, trader, whatever, and also be a pro real estate guy, but that's going to be very difficult, and that's going to be really hard to do at the same time. You need a deep understanding of these things. So especially if you've got 10 income streams, keeping on top of 10 to 15 income streams is going to be very difficult, because you're almost going to be spread too thin from a managing perspective and also an understanding perspective. So the result is you own a lot of things you cannot properly monitor or act on, right? So that's one of the problems with 15 assets, 10 to 15 if you want to call it that. But as he talks about, his goal is to manage downside, and but as I mentioned, it caps upside quite a bit, because if something isn't moving and something else is, would you be better off maybe putting some more risk into that? And you've got to have a plan and process around it, but that's definitely something that you want to consider and you want to be thinking about. So I wanted to put this in because these are two very successful hedge fund managers, but with two completely different styles. So Ray Dalio and Stan Druckenmiller. So Stan Druckenmiller famously said, put all your eggs in one basket and watch the basket very carefully. So, Ray Dalio is all about protect downside, moderate returns, survive every environment. This style will never blow up. You'll never lose all your money, even in a crisis, because you will be spread, you'll be across, different things, you'll be protected. And yeah, in the long run, it should be, there'll be some management, like I mentioned earlier, because there's a lot of different things, but there'll also be, little management from, I need to keep moving stuff across. When you've got someone like Druckenmiller, who, as I said just then, put all your eggs in one basket and watch the basket very carefully. Stanley Druckenmiller went on to average, 30% over 30 years. And, we all know he had 200% of the hedge fund's money short the British pound back in the day. So, that's one thing to consider. Stan Druckenmiller's approach is more thinking, about opportunity costs. Yes, he'll be managing his downside, but he also will be thinking about opportunity costs. But his way of investing, I would say, is a lot more sophisticated. But it goes to show that if you want those, 30% over 30 years, if you do the maths on that, on any lump sum, even from like $100, it's going to be a lot of money. So yeah, you'll rarely have amazing, super duper gains with wide diversification. So look, the verdict: the all-weather model reduces downside. So that is it. If you want to take Ray Dalio's approach, because I believe if you are an investor, if you're a trader, you should look at pros, really good people in the industry, and take stuff that you mirror. I mirror more of a Stan Druckenmiller. I'm looking for, okay, cool, what's moving, what's really kind of, what's going to be good for the next, couple weeks or couple months or the year. That's what you want to do. If you want to take Ray Dalio's approach, it's more about, I don't want to lose money. I will happily take 10% maximum a year if I lose very little money. Then go for that approach. But if you want to go for more of an aggressive approach, which is a bit harder and probably more on the tougher side to kind of really kind of manage that downside, the Stan Druckenmiller approach is probably the one for you. So you cannot master 15 assets at once, and the opportunity cost is the silent killer. So if you were long bonds or you own government bonds, that's been an awful trade, right? Over the past couple of years or so, there's been other things moving a lot. And yeah, the Stan Druckenmiller approach, they put all your eggs in one basket and watch the basket very carefully. If you're going to do that, you've got to have a plan. If you want to learn how to have a plan, I do have a free newsletter. Link to that will be in the description. I'll see you in the next one.